Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at RKLB.
If you find our talks useful, please consider subscribe, like, and comment underneath, and make sure to check out the special 14-day trial link below in the description for StockOracle.
Right, and just to be clear right up front, StockOracle is an AI-aided stock research platform. It's not financial advice, it's not a trading signal service, and it does not provide real-time market data.
Exactly, and that link down there is an affiliate link. That means the channel may earn a commission at no extra cost to you. And please remember that StockOracle's AI insights and their valuation estimates, they can be incomplete or just outright wrong.
Yeah, always verify the important facts yourself. We are absolutely not telling you to buy, sell, or hold anything today. We are just here to lay out both the upside and the downside of the stock.
For sure. So let's get into RKLB, ticker symbol RKLB. We're sitting here on August 6, 2026, and I gotta say, the space sector right now is just incredibly volatile.
Oh, it really is. It's a fascinating study in contradictions. Escaping Earth's gravity is obviously this staggering engineering achievement, but escaping the gravity of a highly leveraged balance sheet, that might actually be harder.
Yeah, and that's the core tension we want to untangle for you today. Is RKLB genuinely positioned to be the premier challenger to SpaceX? Or is its, astronomical valuation masking some fatal execution risks?
That's a great question, because on one hand, you have this explosive top-line growth and undeniable technological validation from the U.S. military. But on the other hand, you've got severe cash burn, a massive acquisition, and some really dangerous delays.
If you're an investor or just someone who's fascinated by the new space economy, the sheer scale of the economics here is staggering. We've really transitioned from space being this realm of science fiction into complex, cutthroat financial realities.
Completely. And we should start with the bull case, the wealth building context. Because to be fair, the hypergrowth of RKLB it's hard to ignore.
Right. The top-line momentum is just undeniable.
Yeah.
I mean, looking at the fundamentals, their full year 2025 revenue hit $602 million.
Which is up nearly 40% year over year.
Yeah, and they didn't just plateau there. In Q1 of 2026, they pulled in just over $200 million for the quarter alone. That is a 63.4% jump from the previous year.
It's massive.
Yeah.
But we have to unpack how they're actually making that money, because it represents this total shift in their business model. They aren't just a rocket launch company anymore.
Exactly. In 2025, nearly 67% of their revenue, that's around $403 million, came from their space systems division.
Wow.
Yeah, it completely dwarfs the money they make from actually launching the rockets.
Right.
It's like they realize that, being the delivery service is fine, but building the actual cargo is where the real scale is.
They're trying to pull off a really difficult pivot, going from a launch provider to an end-to-end space prime contractor. And honestly, it's working in terms of winning the business.
Oh, for sure.
As of Q1 2026, they're sitting on a record $2.2 billion backlog. And they expect about 37% of that to convert into recognized revenue within the next 12 months.
And the military is validating this tech in a huge way. We're talking about an $816 million Space Development Agency contract for 18 satellites.
That's the largest single award in the company's history.
Right. And they also landed a $266 million Space Force contract, plus this brand new $397 million contract for something called flatelites.
Yeah, flatelites, which I know sounds like a completely made-up word.
It really does. What even is a flatellite?
Well, they're basically exactly what they sound like. Instead of a traditional, bulky, school bus-sized satellite, these are flat-packed. Think of it like IKEA furniture for space.
Okay, that makes sense.
Because they're flat, you can stack dozens of them inside the fairing of a single rocket. It maximizes the payload capacity and dramatically lowers the launch cost per satellite.
Which is essential if you're building these massive communication constellations in low Earth orbit. Okay, so the defense sector is totally buying into this ecosystem. But here is where my enthusiasm hits a wall. Building custom defense satellites is incredibly complex manufacturing.
Very much so. It requires constant R&D and specialized engineering.
Right. So if pivoting from just repetitive rocket launches to bespoke satellite manufacturing is hurting their percentage margins, is this actually a profitable pivot, or are they just padding that top-line revenue at the expense of the bottom line?
That structural issue is the dark secret of aerospace manufacturing. Management themselves acknowledge that this shift towards space systems inherently compresses their percentage margins.
Because launching an established rocket is a repeatable process. But building a bespoke spacecraft just isn't.
Precisely. Their trailing 12-month gross margin sits at 36.56%.
Which, doesn't sound terrible until you look at what's left after all the operating expenses.
Yeah, that's the real problem. Their net margin is deeply negative. It's sitting at negative 26.87%. The cost of delivering on these massive defense contracts is just bleeding them dry. Their earnings per share over the last 12 months is negative 33 cents. They are losing money on every single dollar of that massive top-line growth.
So they're bringing in hundreds of millions, but the more they sell, the more money they lose. That math it doesn't work if you want to build a space empire.
Yep, it doesn't.
Which brings up the most glaring question for me. Where is the money coming from to fund all this? If the free cash flow is deeply negative and consensus estimates have them burning through another $174 million in 2026 alone, they have to be leaning on a massive war chest.
Well, currently, their balance sheet shows $1.34 billion in net cash. So they do have a runway to survive normal operations. But, and this is a huge but, they aren't just funding normal operations. They are trying to pull off an $8 billion acquisition of Iridium.
Wait, I need to stop you there. They have $1.3 billion in the bank, they're bleeding cash on operations, and they're buying a company for $8 billion.
Yep.
That is a staggering bet.
It's a bet that fundamentally alters the DNA of the company. The goal, which they expect to close in 2027, is to create a fully vertically integrated space behemoth.
Okay, so by acquiring Iridium, Rocket Lab gets immediate control over this massive global satellite connectivity and IoT network.
Right. They don't just want to build a satellite and launch it. They want to own the communication network it operates on and, charge subscription revenue for it forever.
I mean, the strategic logic of vertical integration makes sense. It's how you build a moat. But the financial logic, it feels like a cash-strapped startup buying a massive legacy telecom network just to force the issue.
It's a massive risk.
How do you even finance a deal that is 6 times the size of your cash on hand? Especially when the target comes with its own mountain of existing debt.
You use a highly leveraged, incredibly aggressive financial structure. The deal is backed by a $3.6 billion, 364-day senior secured bridge facility from Deutsche Bank and Wells Fargo.
Let's translate that for a second. A 364-day bridge facility is basically a massive short-term corporate loan with a ticking clock. It's designed just to bridge the gap to close the deal.
Exactly. They have less than a year to refinance that $3.6 billion into long-term debt, or they are in massive trouble.
And part of the reason they need that bridge facility is to refinance roughly $2.1 billion of Iridium's existing debt that Rocket Lab is now inheriting, right?
Right. But that is only the debt side of the equation. To cover the rest of the purchase price, they're using a cash plus stock exchange. Iridium stockholders are slated to get $27 in cash, plus a ratio of Rocket Lab shares.
And this is where the financial engineering gets truly dangerous for anyone holding Rocket Lab stock right now.
It does. The exchange ratio is fixed at 0.4 shares, but there is a floor price written into the deal at $67.50.
Meaning, if Rocket Lab's stock price drops below that 67.50 floor, the math breaks. The only way to fulfill the contract and make the Iridium shareholders whole is for Rocket Lab to literally print more shares out of thin air.
Which triggers massive dilution. If the stock price falls, they issue more shares, which makes the existing shares less valuable, which can drive the stock price down further,
forcing them to issue even more shares.
Exactly. It is a potential death spiral.
And this explains so much about their behavior. This M&A strategy is the lens through which you have to view the entire company. It's why there are no stock buybacks. It's why there are no dividends.
Every single spare dollar is being hoarded for acquisitions, satellite manufacturing capacity, and the debt service that is coming.
The binary financial risk is just immense. If this integration falters, or if, say, the macroeconomic environment makes refinancing that bridge loan incredibly expensive, the debt load could crush the underlying business.
Well, here's the operational catch. To make this massive Iridium integration work and to launch their own mega constellations profitably, they can't rely on their current rockets. They need heavier lift capabilities.
We definitely have to talk about the physical rockets themselves because they are the bottleneck to this entire grand vision. These are the major catalysts for the stock.
Operationally, Rocket Lab is currently a tale of two rockets. First, you have the Electron vehicle. This is their small lift workhorse. It has been incredibly reliable.
Yeah, 100% mission success across 21 launches in 2025, over 90 launches historically.
Right. And they're actually preparing for their 90-second launch retry after a recent last-minute abort, which is a standard safety procedure, to be fair.
But the Electron is a small truck. It's great for putting a few small satellites into orbit. But to launch the massive Iridium replacements, they need their new medium-lift rocket, the Neutron.
And Neutron is where the operational reality gets incredibly harsh. The maiden flight was originally targeted for much earlier, but in January 2026, they suffered a catastrophic Stage 1 tank rupture during structural testing.
Let's explain why a tank rupture is so devastating. A rocket's fuel tank isn't just a gas tank in a car. It's essentially a giant, ultra-thin balloon holding thousands of gallons of explosive, super-chilled cryogenic fuel.
And it has to handle the insane vibrational stresses of launch.
Exactly. If that tank ruptures in testing, you can't just patch it with duct tape. You have to go all the way back to the metallurgy, the carbon composites, the core structural design. It takes months to fix.
And that failure pushed the entire timeline back significantly. The maiden flight of Neutron is now targeted for Q4 2026. But even when Neutron finally flies, those early flights are going to generate low or even negative gross margins.
Wait, so even if they perfectly execute the launch in Q4, they still lose money on those early flights?
Yes. The economics of a new rocket are punishing. You have massive fixed costs. The launch pad infrastructure, the specialized labor force, the factory.
Before you even sell a ticket to put a satellite on that rocket, you've spent tens of millions.
Exactly. Early on, the revenue from the payload doesn't come close to covering the cost of building the rocket. It takes dozens of successful flights, recovering and reusing the boosters, to actually reach profitability.
You're essentially buying market share at a massive upfront loss. And they're doing this while operating in the shadow of an absolute giant. They are directly competing with SpaceX.
Which is incredibly tough. Rocket Lab is considered one of the few credible, publicly listed challengers to SpaceX. But SpaceX's dominance in launch cadence is absolute right now.
Although there is a broader sector headwind that affects everyone. Even SpaceX is feeling gravity. Recently, they saw a 12% secondary market sell-off following their debut earnings because of soaring AI capital expenditure concerns.
That's a fascinating macro point. Investors are pouring so much money into artificial intelligence infrastructure right now that capital is actually draining away from capital-intensive sectors like space.
It proves that no one, not even SpaceX, has unlimited, consequence-free capital anymore.
And while SpaceX has the cushion of vastly greater resources, Rocket Lab does not. Rocket Lab is essentially in a race against time. They have to prove Neutron works before investor patience runs out and before their cash runway gets consumed by the Iridium deal.
To add to the friction, they're also currently blocked by a European Union regulatory review for their acquisition of a company called Mynaric.
Yeah, and Mynaric makes optical link technology. Basically, the lasers that allow satellites to talk to each other in orbit. It's a critical component for the defense contracts. The EU delaying that means Rocket Lab doesn't have internal control over a key piece of the supply chain.
It's just hurdle after hurdle.
Yeah.
Regulatory blocks, tank ruptures, debt refinancing, which makes the contrast between the shiny rocket launches we see on PR videos and the grim reality of the technicals so jarring.
Let's pivot to those technicals because the price action is incredibly volatile. As of August 6th, the stock is trading at $74.82. That is down over 50% from its high of $151 back in May.
But it did just see a 27% bounce in the last 5 days. If you're a retail investor holding the stock, a 27% bounce sounds like the turnaround has arrived.
It does, but there's a massive caveat to that rally. The volume. That 27% bounce happened on volume that was only 0.69 times the 3-month average.
And for those unfamiliar with technical analysis, a price jump on low volume means there is no real institutional conviction behind the move.
Right? It's not large hedge funds buying in. It's just a low-volume relief rally in what is still a deeply bearish trend. The stock also has a beta of 3.0.
Which means it is violently sensitive to the broader market. If the S&P 500 drops 1%, you can expect Rocket Lab to drop 3%. It's currently testing serious technical resistance at $75.
And if it fails to break through that moving average, the next major technical support floor is all the way down at $56.
And the valuation itself is demanding absolute perfection. The stock is trading at a price-to-sales ratio of nearly 66 and almost 20 times price-to-book value.
All while generating negative earnings.
Exactly. At a 66 times sales multiple, you are not pricing in the current reality. You're pricing in a future where Neutron flies flawlessly, the Iridium integration is seamless, and there are no macro shocks.
You are paying a massive premium for perfection in an industry where perfection is physically and financially impossible.
Which brings us to sentiment and, honestly, the risks and the bear case. Because there is a glaring red flag when it comes to insider activity.
Yeah, if you want to know what the people running the company actually think about that 66 times valuation, look at what they're doing with their own money.
Hmm.
Over the last 90 days, insiders at Rocket Lab have net sold 3.5 million shares.
We're looking at 79 individual sell transactions versus just 11 buys.
That is heavy insider dumping.
I really have to challenge the bullish sentiment we see online with this data. If the company is touting a record $2.2 billion backlog and they're winning these Space Force contracts, why are the insiders running for the exits?
It's a stark disconnect.
It's like watching the captain of a cruise ship quietly loading his own personal luggage into the lifeboats while getting on the loudspeaker to tell the passengers that the weather is perfectly fine.
That's a great analogy. What is highly probable is that those insiders are pricing in the execution risks that the retail market is cheerfully ignoring. They know exactly how brutal that Iridium debt integration is going to be.
And they know how tight the engineering timeline is for Neutron.
Exactly. The sentiment across the market is really fractured right now. You have defense-focused funds who are bullish on the government contracts, but they're terrified of multiple compression, the idea that the market will just stop paying 66 times sales.
And that perfectly sets up our final verdict for today. When you weigh all of this data, the undeniable top-line growth against the crushing debt, the operational delays, and the insider selling our analysis, delivers an investment rating of 5.
Which represents a firm neutral stance.
It is the ultimate wait-and-see rating. The staggering potential is entirely offset by the binary risk of the Iridium deal and the execution uncertainty of Neutron.
So for you listening, there are two critical near-term catalysts you need to watch. First, the upcoming Q2 2026 earnings call. Management has guided for $225 to $240 million in revenue.
And to support a 66 times multiple, they can't just meet that guidance. They have to beat it comprehensively. Any weakness there will be punished severely.
The second catalyst is physical. They critically require a flawless retest of the Neutron Stage 1 tank. If that carbon composite tank fails again under pressure, the Q4 launch gets pushed deep into 2027.
And if that happens, the cash burn accelerates, the Iridium timeline gets squeezed, and the valuation multiple could compress violently.
But on the upside, if the test succeeds, the narrative shifts back from delayed to operational.
It is an incredibly high-stakes waiting game. Which leaves me with a final thought for you to chew on today for your long-term view. For the last decade, space companies were funded by venture capital that didn't care about profitability, they just wanted to see a rocket reach orbit.
Right, growth at any cost.
But as that era ends, what happens to the future of space exploration when the literal cost of reaching orbit stops being subsidized by infinite investor patience?
It forces a total reckoning. The physics of reaching low Earth orbit haven't changed, but the physics of the financial markets have completely inverted. You have to prove you can make $1 in the vacuum of space, not just burn one.
Exactly. You have to look beyond the pyrotechnics on the launch pad and look straight at the balance sheet. Well, that wraps up our analysis on Rocket Lab. Please remember to subscribe, like, and comment underneath if you enjoyed this.
And don't forget to check out the special 14-day trial link below in the description for StockOracle to do your own AI-aided research.
Thanks for listening, and we'll catch you on the next one.